This is the first of a two-part series on how to think and trade like a hedge fund manager. During my time at FXCM, when I started the research portal DailyFX from scratch, I worked with a lot of hedge funds. We talked about their trading strategies, risk management, and overall methodologies. I learned a lot and felt that their techniques were not only valuable, but also very approachable for many individual and retail traders. Hedge fund managers have a very methodical approach to investing. Heck, you wouldn't pay them all of their fees if you didn't think they were smart and disciplined. There are a number of techniques that hedge fund traders use to trade. We'll talk about those next week. Today, I want to talk about how to think like a hedgie. Most hedge fund managers follow a 5-step process that involves defining the strategy, establishing money management rules, testing, understanding of performance, drawdown, and refinement. Now, let's dig into each of these deeper. First, defining a strategy means to decide whether to trade based upon fundamentals, technicals, or both, whether to trade range, trend, or breakout, and whether to trade high frequency, which is a fancy word for short term, or long-term position trading. Within that, there are even more details to iron out. For Forex hedge funds, for example, before they even start trading customer funds, they'll need to determine and decide what currencies they'll trade, majors, the crosses, or exotics. What time frame they'll trade, 15-minute charts, hourly charts, or daily charts, and whether they'll hold the position over the weekend and into big events. Then there's money management. How much will they risk per trade? What parameters will the stops be placed on? Will it be significant levels or equity, for example? Will they scale in and scale out positions, or will it be single entry, single exit? And when to take profits and trail stops. Once all of this is determined, it's time to test because they're not trading just on guesses. Everything needs to be tested. This is even more important for those of us who trade our own money and not other people's money like these hedgies. They may have the size, but win or lose, they're still collecting a salary. We, on the other hand, are risking and trading our own hard-earned capital. Ideally back test, then demo test, then live test. And look at a more granular time frame to make sure you're getting in and out at the levels that you think you are. Finally, review your results. Understand the strategy and its performance. What is the win rate? How many trades are there? What is the correlation between the trades and the profit factor? You've also got to understand drawdown. How many consecutive losing trades have there been? What is the average drawdown per trade? And what is the biggest drawdown? Is that on a closing basis or on an intraday basis? And actually, that wasn't the last one. The last one is improvement. Hedgies will regularly sit down with their managers or their compliance departments to look at what works and what doesn't work. Whether losers are happening more during certain times of the day or around key news releases to see if there are simple changes that can be made to refine their strategy or their fund's performance. Hedgies take trading and analyzing their own performance seriously because they have accountability to their higher-ups, compliance, and customers. It would serve all of us well to think about all of these things as we look and follow their 5-step process because we're trading our own money and not other people's money. A large part of my success and the success of my zip trades comes from understanding my strategy inside and out, understanding when it loses, when it wins, understanding that we should be trading between 10 a.m. New York time and 8 p.m. New York time, for example, that our best trades are in Asia, Europe, and early North America. And by understanding all of this, including not trading in front of big news releases, when I have drawdowns, I know that's just part of the process. When I have wins, I know that it's reinforcing the efficiency and the efficacy of the strategy. Being successful in trading is about finding a technique that works for you, not being the jack of all trades and trading all time frames, all currency pairs, all styles. Deciding whether you'll trade fundamentals, technicals, 15-minute charts, or daily charts. Narrowing your process down will ultimately make you a better trader. This is what hedge funds do, and I think it would be wise for you to follow some, if not all of these steps as well. Come back next week for strategies that these hedgies like to trade and how you can do so too.